Okay, today we're going to look at 14-4B, entries for bonds payable and installment note transactions. So we're going to be working with bonds and notes in the same transactions. Okay, the following transactions were completed by Montague Inc., whose fiscal year is the calendar year. And if we go through our transactions down here to our instructions, we're only going to be doing step 1, generalize the entries to record the foregoing transactions. Okay, so let's go back up to our top transaction. July 1st, we issued a $55 million of 10-year, 9% callable bonds dated July 1st, year 1, at a market effective rate of 7%, receiving cash of $62,817,040. Interest is payable semi-annually on December 31st and June 30th. Now that is a lot of information in one transaction, so we're going to get a blank piece of paper and we're going to break this down. Okay, so first of all, it's July 1st of year 1, and we had $55 million bonds payable. It was a 10-year bond at 9%. There was a 7% market rate. Okay. It also told us that we had received $62,817,040 in cash for these bonds. Okay. So this tells us our bonds payable. This tells us our cash. We're obviously making some money here since we only issued $55 million and we received $62 million. So we do have a premium and we need to calculate that premium. So we're going to take this 62 and subtract the $55 million. And we're going to get $7,817,040. And this gives us our premium. Okay. So we're going to take these three numbers, bonds payable, cash, and our premium, and this is what's going to create our journal entry. The rest of this information is important. We're going to need this when it comes time to pay the interest on our loans, but we just don't need it right now. Okay, so I'm going to come over here to my journal, and our date was July 1st. Now it said year 1, so I'm going to start with 2018 for my year. Okay, so we received cash, so we're going to debit cash. So we're going to list cash first for the $62,817,040. Oops, I missed a zero in there. Okay, and then we have our bonds payable, which it's a payable, therefore it's a liability. So to increase our liability, we're going to credit it for the $55 million. And then our premium. So we're going to put premium on bonds payable. And that's also going to be a credit for the $7,817,040. Okay. So that's our first transaction. The next one says, October 1st, we borrowed $450,000 by issuing a 6-year, 8% installment note to Intexicon Bank. The note requires annual payments of $97,342, with the first payment occurring on September 30th of year 2. So now this is our note. Our first one is our bond. The second one's our note. Again, a lot of information in one transaction, so we're going to use our scratch paper here and we're going to break this down. So we're now on October 1st of year 1. We borrowed $450,000. Okay, so this becomes our note payable. It was a 6-year, 8% bond, and our payments were $97,342. Okay, now when it comes to bonds, when it comes to notes, we don't have the premiums that we do with the bonds. So all we're going to do for this transaction is use this $450 or $450,000. Okay. So our date is October 1st. Again, we are receiving cash, so cash will be your debit for the $450,000. And then we are issuing a note for $450,000. Okay, since it's a payable, it's a liability, so we credit it to increase it. The next one, December 31st, accrued $9,000 of interest on the installment notes. The interest is payable on the date of the next installment note payment. So this is an adjusting entry. This is saying that we have accrued interest of $9,000, but we haven't paid it yet. Okay, so again, we have our date of December 31st. So we've accrued an interest expense of $9,000. So we're going to debit the expense. It's just an adjusting entry at the end of the year. But again, we've accrued it but have not paid it, so it becomes a payable. We need to show that this was an expense for year one. But we also need to show that we still owe that money. We have not actually paid it yet. The next transaction paid the semi-annual interest on the bonds. The bond premium amortization of $390,852 is combined with a semi-annual interest payment. Okay, so it only gives us one number to work with, but we have some numbers from before. So we'll pull in our scratch paper here. Oops. Okay, so we're looking at December 31st of year one. We're looking at paying on our bond, and we know that our bond was $55 million. So we're going to start there. This is our principal. We're going to multiply that times our rate, which was 9%, which is there, and times our time. It was semi-annual, so we'll multiply it by 0.5. And when we do that, we're going to get $2,475,000. And this is the cash we're going to be paying. Okay, that's the cash we're going to be paying. Now, our book tells us what our premium is. It tells us that our premium amortization is $390,000. But I'm one person that wants to know where all these numbers are coming from. So the way that they got that premium amortization is they took this $7 million and they divided it by 20 payments. Okay? So if we do that, if we take the $7,817,040 and divide it by 20, that's where they're going to get that $390,852. The number they give you in the book. Okay. So if we take these two numbers and we subtract them, okay, take your cash minus your premium, we're going to get $2,084,148, and this gives us what our actual interest expense is. Okay, so now we're going to take these numbers and put them into our journal. Okay, let's start with the easy part, the date, December 31st. Okay, we're going to start with our interest expense. An expense is an expense, so we're going to debit it to show that it increased. And that was for the $2,084,148. And then we have our premium on bonds payable for $390,852. And since we're paying this, we're going to credit our cash, $2,475,000. Okay, we're on to year 2. June 30th, paid the semi-annual interest on the bonds. The bond premium amortization of $390,852 is combined with the semi-annual interest payment. That transaction looks awfully familiar. As a matter of fact, it's the exact same transaction we just did. So there's nothing to calculate. We're just going to put it in here again. So June 30th. We're in year 2, so since I started in 18, oops, let me try that again. Since I started in 2018, this one becomes 2019. So we have our interest expense. Of $2,084,148. Our premium on bonds payable, $390,852, and our cash of $2,475,000. Okay. Next one, on September 30th. We paid the annual payment on the note, which consisted of the interest of $36,000 and the principal of $61,342. Now that transaction sounds pretty easy, right? We got principal on a note, so note payable, interest, so interest expense, and then we paid it, so cash. But we have to keep in mind that up here on the 31st, we recorded $9,000 of interest already on this note when we did our adjusting entry. Okay, so we have a little bit of calculation to do on this one. So it is September 30th of year 2. Okay, we have, our book tells us we have $36,000 in interest. We had a $9,000 adjusting entry that we've already put into our interest expense, but we do need to pull it out of our interest payable. And if we subtract those two, we get $27,000, and this becomes our interest expense. So, and then the problem tells us that we have a principal of $61,342, so this is our note payable. If we take these numbers, this 9,000, 27,000, and the 61,342, and we add them all up, we're going to get 97,342, which becomes our cash amount. And if we look back up on October 1st, that's what October 1st told us our payments would be, $97,342. Okay, so now we're going to take these numbers and put them into our journal. So it is September 30th. We're going to start with our interest expense. Which was $27,000. Our interest payable, we're going to also debit this. We no longer owe it. We're paying it right now. Our $9,000. Our note payable, again, we're paying on it right now, so we no longer owe this amount. $61,342. And since we're paying all three of these, we're going to credit cash for their total, which we calculated on the other side as $97,342. Okay. December 31st, accrued $7,773 of interest on the installment notes payable on the next installment note payment. Okay, so again, another one of those adjusting entries where we're going to debit interest expense. For the $7,773 and credit interest payable. Okay, we need to record that we accrued this amount of interest, so we debit interest expense and show that we still need to pay it, so we credit interest payable. December 31st, paid the semi-annual interest on the bonds. The bond premium amortization of $390,852 is combined with the semi-annual interest payment. Again, the same as the transaction on June 30th and December 31st. So it is December 31st, interest expense, $2,084,148. Premium on bonds payable, $390,852, and a cash credit of $2,475,000. Okay. So now we're into year 3. Recorded the redemption of the bonds, which were called at 103. The balance in the bond premium account is $6,253,632 after the payment of the interest and amortization have been recorded. Record the redemption only. Okay, so we're going to grab our scrap paper here. I'm going to start up at the top. And this is June 30th of year 3. It's telling us that they were called at 103%. So we have bonds payable of $55 million. We had the premium of $6,253,632. Okay. It was called at 103%, so we need to see what that is. So we're going to take the $55 million and multiply it by 1.03. And we're going to get $56,650,000. And this is our cash amount. Okay. We're also going to take our bonds payable and add our premium to it. We're going to get $61,253,632. And then we're going to subtract our cash amount that we calculated at the top. And we get $4,603,632. And this is how much we gained. Okay, this was our gain on redemption. So we have our bonds payable, our premium, our cash, and our gain on redemption. Okay, so we're going to take these numbers and put them into a transaction. It is June 30th. We are in year 3, so in my case it's going to be 2020. First, the bonds payable. Okay, it is a liability. They have been called, therefore we no longer owe this amount of money. So we're going to credit the bonds payable, we're going to debit the bonds payable account to show that we no longer owe that money. We're also going to debit the premium account to show that we no longer have a premium on our bonds payable. Hold on, I pulled the wrong number there. should be 6,253,632. Okay. We're going to credit our gain on redemption of bonds for the 4,603,632. And we're crediting cash because we're paying on our bonds. Okay. And there's that transaction. Okay. Last transaction, paid the second annual payment on the note, which consists of interest of $31,093 and principal of $62,249. Again, sounds easy, but we need to keep in mind that we did that adjusting entry. So we're going to grab our scrap paper again. And it is September 30th of year 3. We had $31,093 of interest. We had $7,773. Oh, sorry, that's a 3. Of interest payable. Subtract them, we're going to have $23,320 for our interest expense. And our book tells us we had a $66,249 on the premium, so that's or on the principal, so that's the note payable. And if we take the 7773, the 23,320, and the 66,249, and add them all up, we get 97,342, which gives us our cash amount. Okay, so we're going to take that and put them into it in transaction on September 30th. Start with interest expense. It's going to be a debit for $23,320. Interest payable. It's going to be a debit for $7,773. Note payable. A debit of $66,249. And then cash would be a credit of $97,342. Okay, and that finishes this problem.